lesson for part 2 before I'll be moving on to part 3, where I'll be going through Wyckoff, and that will be the last chapter to then sum up my entire course. So in this lesson I'll be going over price cycle, hoping you guys understand it and how we use price cycle as a confluence when taking our trade. Now I want you guys to draw this out, note it down, as is important, as these are the 4 key phases in price cycle. So we got the consolidation, and then we got the expansion, and then we get the retracement, and then we'll usually get the reversal. Okay, now once you guys drew that out, I would like you guys to note down these bullet points, and the way I'll be explaining it all in order. And these are the 4 points I'd like you guys to write down: the elements of the trade setup. When there's an expansion, you'll notice an order block or a zone is left behind. When price is retracing, is usually retracing to fill in any inefficient price action, and when price reverses, it usually seeks to take out any liquidity, right? And then consolidation, just write equilibrium. That's not really that important, but these are the most 3 important points I want you guys to note down. Now let's get straight into it. What is expansion? It is when price moves quickly from a level of equilibrium. In other words, when price breaks out of consolidation. So this is our consolidation phase, right? Now what happens here? Price breaks through that consolidation. That's what we classify as our expansion, right? When price is just ranging like this, we classify that as a consolidation. When price expands out of that phase, we classify that as an expansion. Now again, equilibrium is 50% of the high and the low of an area that consolidates. So this is our consolidation, this is the high of the consolidation, and this is the low of the consolidation. So equilibrium will be 50% of it. Okay. Now once price expands outside of this area of consolidation, it will reprice us with an area to execute a position from, so that we can join in on the ride, leaving either an order block or a zone. Now remember when I told you guys to write down expansion equals order block or zone? Now notice how price expands out. Yeah, when price expands, it usually expands with imbalance, right? So we would expect a retracement back to an order block or a zone that it would have left behind, right? So if you look at this example here, we have a consolidation, right? And then we got that expansion. But notice when the price expanded out of this consolidation phase, what did it create? Imbalance, right? And just before that imbalance, what can we identify right here? A clean indecision candle. Now what does that mark out? A premium supply zone, right? Now I just want you guys to keep that in mind. Now I'm going to go over to retracement. What is a retracement? It is when price pulls back inside the recently created price range. So this is the price range, right? And retracement pulls back within this price range. This is the swing high and this is the swing low. So when price retraces, it retraces within this range. Now after price expands to either direction, we must look for an inefficient price action created during the quick move. This will then give us an area where we can assume price will retrace or pull back to. Now again, if I go back to this example here, we have that consolidation and then we got that expansion. Now remember what it says in the slide. After price expands to either direction, we must look for any inefficient price action. We got that expansion. Once we identify that expansion, we start to look for inefficient price action, and we identify that right over here, this whole imbalance, right? Now once we identify that imbalance, we can assume price will retrace or pull back to that area. This then allows us to identify any points of interest where we can set our orders of. Number 1, price expands, which may create inefficient price action. As we can see in this example, price expands, it creates inefficient price action. Number 2, price pulls back to fill in any inefficiency, to allow both the buyers and the sellers a fair opportunity to liquidate the market. So we identify the inefficiency, and we identify the point of interest where we can look to take set our orders at or execute a position of. And number 3, and then when price comes back to fill in that inefficiency, it will then continue in its intended direction. Now this is the same example. We had that consolidation, we had that expansion. We identified that inefficiency, so we can already assume price is going to pull back to fill in that inefficiency. We then look for a point of interest where we can look to execute a trade-off, and we identify that supply zone right over here. Price pulled back to the supply zone, right? It fills in that inefficiency. Price has now retraced back to fill in that fair value gap and has mitigated the supply zone. Now let's move over to reversal. What is a reversal? It is when price moves in the opposite direction from what current market direction was moving in. So if it was in an uptrend, it will go from an uptrend to a downtrend, okay? The aim for the reversal is to seek for any liquidity and to take them out, such as trendline liquidity, equal lows, and equal highs. Now, if I go to this example here, 1. Consolidation. Number 2. Expansion happened, created inefficiency. Number 3. Price pulls back to fill in that inefficiency. Number 4. Price mitigates that supply zone. And number 3, we get that reversal. And what's the aim for the reversal? To seek for any liquidity. And what can we identify right here? A trend line. And again, in a retail's point of view, they would have bought of this trend line. They would have been in profit, and what do institutions do? Boom, sell price down to take out any stop losses at this trend line. Now do you understand the cycle? Consolidation, expansion. Expansion would leave us an order block, or a zone. As you can see, it left us a supply zone, right? Number 2, retracement. Retracement fills in any fair value gaps, imbalances, inefficient price action. They're all the same thing. The retracement, what did it do? It fills in this inefficient price action. And number 4, reversal, seeks to take out any liquidity. What do we have here? Trend line. And what is that? Liquidity. What did the price do? Seeks to take it out. Now, that is literally all. These are the 4 concepts to understanding price cycle. And I'm going to quickly show you guys examples before I wrap up this lesson. Pound CAD. Why did I take this trade? It is very, very straightforward, guys. Yeah? Now, with the understanding of the price cycle, we know that this is our consolidation phase, right? And then what happened right over here? Price expands. And remember, what did I tell you about expansion? It would leave us some inefficient price action. So that when price retraces, we can assume that it will retrace to fill in this inefficient price action before selling off, right? So we got that consolidation. We then got that expansion. Now remember, once we get that expansion, we look for the order block or the zone that it left behind. And as we can see, we can identify this very nice indecision candle. And what does that mark out? A supply zone. Now the retracement. Retracement seeks to fill in any inefficient price action. This whole candle is the inefficient price action. Price pulls back to fill in this price action. And finally, number 3, retracement. What was the purpose of the retracement? To seek for any liquidity. And now if we head over to that 4-hour time frame, what can we identify? Right, let me replay price to this area over here. What can we identify? Or let's stick to the hourly. What can we identify right here? Very nice trend line liquidity, right? So in a retail's point of view, when price comes to this trend line, what are they looking to do? Buy up again, right? But this is all liquidity. So what's price going to do? That reversal is going to seek to take out that liquidity. So now we head back to that 15-minute and let's see what price does. Price starts to sell off. Look, it gets the retail traders excited. Retail traders would have bought at this point over here. And then let's see what happens. And there we go. That liquidity has now been taken out. We would have sold here and caught that whole reversal. Does that make sense, guys? So I hope the whole price cycle concept is fairly straightforward. It consists of 4 phases. The consolidation, expansion. The expansion would leave us an order block. The retracement will seek to fill in any inefficiency. This was the inefficient price action that it fills in. And then the reversal seeks to take out any liquidity. And our liquidity was this trend line right over here. Now, next example. USD JPY. Let's look at the 15-minute. Now, this was our consolidation phase, right? Now, once price was consolidating, what happened? It expanded. right? And what did it create right here? Liquidity, right? All right. Now that we understand that, when price expanded, did it create? Inefficient price action. So we know when price is going to pull back, it's going to seek to fill in any inefficient price action. And what do we also identify before this expansion? This very nice zone on the 15-minute clean indecision candle, right? So now if I zoom out, this is our consolidation phase, this is our expansion. Price reverses to fill in that inefficient price action, and then we get that reversal. Price mitigates our 15-minute order supply zone, and then seeks to take out, the reversal seeks to take out this liquidity. Now, is it all straightforward? Does that all make sense? Now, if I was to take this trade, I would have entered right here. If you want to be aggressive with your stop loss, you could have had it at the wick of the zone and your TP at the liquidity. You would have caught a nice 1 to 14 risk to reward. But the whole point of this, I want you to understand the cycle: consolidation, expansion. The retracement seeks to fill in any inefficient price action. We have that inefficient price action here. It mitigates our zone. And number 4, the reversal seeks to take out any liquidity. We have equal lows, and the reversal takes out that liquidity. Do you see the beauty of this price cycle? It's very straightforward. Gold. I have multiple examples on gold. Let's play back to the 1 hour. I've already got them drawn out, but let's find them right here. Okay, I'm going to go through 3 examples on gold. Alright, sweet. Let's replay price to this point over here. What can we identify here? A consolidation phase, right? Once we spot our consolidation phase, we wait for the expansion, and we got that expansion right over here. Price expanded to the upside. When price expanded, what did it create? Inefficient price action, right? And it left a very nice demand zone. Look at that indecision candle. Okay, now once price expands, we expect a retracement. What's the purpose of the retracement? To fill in any inefficient price action. We have inefficient price action here. Price has now retraced. It has filled in that inefficient price action. Price has now mitigated the demand zone that was left behind just before that expansion. Price has now mitigated that demand zone. Now, this is the reversal phase. Now, what is the purpose of the reversal? To take out any liquidity. What is this? A trend line, right? So what is this? Liquidity. Now, what's price going to do? Take out that liquidity. The whole purpose of the reversal is to seek for any liquidity. And what's it going to do now? It's going to shoot up to take out that liquidity. Boom. Liquidity has now been taken out. Now, let's move over to the next example. This example right over here. Let's go to the 30-minute. Sweet. So, price was in a consolidation phase. What happened? Expansion. Price expanded outside of that consolidation phase. Now, what did it leave? Inefficient price action, right? So once we got that expansion, we look for the order block just before that expansion, and we can identify that right over here. Now, once price begins to retrace, we can assume it's going to fill in that price action like it did and mitigate this order block. Once it mitigates this order block, now this becomes the reversal phase, right? Now, what's the purpose of the reversal? To seek for any liquidity. Now, what can we identify at this point right over here? What is this? Trendline liquidity, right? Put a pound sign on that and mark that out as liquidity. So now we sell off gold to take out that liquidity, and boom. That's crazy, huh? That's the beauty of the price cycle. It will forever repeat itself. So I've been through this example, I've been through this example. I think I skipped this example, didn't I? Yeah, I did. I will go through that now. Let's replay price back to this point over here. And go back to that 30-minute. Alright, sweet. Was it a 15? find out. Sweet. So, as we can identify here, what is this? An area of consolidation, right? After this area of consolidation, what happened here? Price expanded. And once it expanded, what did it create? Inefficient price action. Just before this expansion, we identify a very nice area of demand right there. Correct? So let's head over back to the higher time frame. Look at the zone we went off. You see this 1 hour clean indecision candle? Bodies right in the center, wicks on either side. Right. So we have now identified the consolidation phase. We identified the expansion. Now, what did price create up here? Equal highs. Now what's equal highs? Liquidity, right? So now we know when price is retracing back to fill in that inefficient price action and it mitigates our demand zone, we now know the reversal is going to seek to take out these equal highs. So let's see what happens. It didn't take out the liquidity, but essentially when it comes to setting the TP, you would have targeted those highs. So you would have entered right here with your stop loss, either at the close of the wick, or you can have it a few pips below, depending on how aggressive you are, and your TP would have been that high. Let's see what happens. Price, that would have hit your TP, and then that price cycle is what I went through already with you guys. So that was the consolidation phase. Price expanding out of the consolidation phase, pulls back in, creates that trend line liquidity, and then mitigates that order block, and then boom, melts. So I hope that was fairly straightforward with you guys. Any further questions, feel free to message me, but make sure you back test this cycle. You will find it playing out at least 80% of the time. Right? Alright guys, take care.